environment where managers are measured over the long term. Even people who function as their own manager are infected by the unhealthy nuances of this environment. In many ways, we have become enslaved to a marketing machine that all but guarantees underperformance. Caught in a vicious circle, there appears to be no way out. But of course, as we have learned, there is a way to improve investment performance. What we must do now is find a better way to measure performance. The cruel irony is that the strategy most likely to provide above-average returns over time appears to be incompatible with how we judge performance. In 1986, V. Eugene Shaheen, a Columbia University Business School alumnus and portfolio manager in the U.S. Trust, wrote a follow-up article to Buffett's The Super Investors of Graham and Doddsville. In his piece, titled Are Short-Term Performance and Value Investing Mutually Exclusive? Shaheen took on the same question that we are now asking: how appropriate is it to measure a money manager's skill on the basis of short-term performance? He noted that, with the exception of Buffett himself, many of the people Buffett described as super investors undeniably skilled, undeniably successful face periods of short-term underperformance. In a money management version of The Tortoise and the Hare, Shaheen commented, "It may be another of life's ironies that investors principally concerned with short-term performance may very well achieve it, but at the expense of long-term results." The outstanding records of super investors of Graham and Doddsville were compiled with the apparent indifference to short-term performance. In today's mutual fund performance derby, Shaheen explains, the super investors of Graham and Doddsville would have been overlooked. The same is also true of the super investors of Buffettville. John Maynard Keynes, who managed the Chest Fund for 18 years, underperformed the market 1/3 of the time. Indeed, he underperformed the market the first 3 years he managed the fund, which put him behind the market by 18 percentage points. The story is similar at the Sequoia Fund. In the marking period, Sequoia underperformed 37% of the time. Like Keynes, Ruane also had difficulty coming of age. Over the years, he confessed, we have periodically qualified to be the kings of underperformance. We had the blurred vision to start the Sequoia Fund in mid-1970 and suffered the Chinese water torture of underperforming the S&P 4 straight years. By the end of 1974, Sequoia was a whopping 36 percentage points behind the market. We hid under the desk, didn't answer the phones, and wondered if the storm would ever clear. But of course the storm did clear. 7 years after inception, Sequoia had gained 220%, versus a gain of 60% for the Standard & Poor's 500 index. Even Charlie Munger couldn't escape the inevitable bumps of focus investing. Over 14 years, Charlie underperformed 36% of the time. Like other focus investors, he had a string of short-term bad luck. From 1972 through 1974, Munger fell behind the market by 37 percentage points. Over 17 years, Lou Simpson underperformed the market 24% of the time. His worst relative performance, which occurred in a 1-year period, put him 15 percentage points behind the market. Incidentally, we saw the same performance trends when we analyzed our laboratory of 3,000 focus portfolios. Of the 808 portfolios that beat the market over the 10-year period, an astonishing 95% endured some prolonged period of underperformance 3, 4, 5, or even 6 years out of 10. What do you think would have happened to Keynes, Munger, Ruane, or Simpson if they were rookie managers starting their careers in today's environment, which can see only the value of 1 year's performance? Yet, following the argument that using a focused strategy will likely result in periods of underperformance, how can we tell, just using price performance as our measure, whether we are looking at a very bright investor who is having a poor year, or even a poor 3 years, but will do well over the long haul, or a manager who perhaps lacks the skills to be a good focused investor? We can well imagine what Warren Buffett might say. For him, the moral of the story is clear: we have to drop our insistence on price as the only measuring stick, and we have to break ourselves of the counterproductive habit of making short-term judgments. But if price is not the measuring stick, what are we to use instead? Nothing is not a good answer. Even buy and hold strategists don't recommend keeping your eyes shut. We just have to find another benchmark for measuring performance. Fortunately, there is one, and it is the cornerstone of how Buffett judges his performance and the performance of his operating units at Berkshire Hathaway. Warren Buffett once said he wouldn't care if the stock market closed for a year or two. After all, it closes on Saturday and Sunday, and that hasn't bothered me at. 46 It is true that an actively trading market is useful, since it periodically presents us with mouth-watering opportunities, said Buffett. But by no means is it essential. To fully appreciate this statement, you need to think carefully about what Buffett said next. A prolonged suspension of trading in securities we hold would not bother us any more than does the lack of daily quotations for Berkshire's wholly owned subsidiaries. Eventually our economic fate will be determined by the economic fate of the business we own, whether our ownership is partial, in the form of shares of stock, or total. If you owned a business and there were no daily quotes to measure its performance, how would you determine your progress? Likely you would measure the growth in earnings, the increase in return on capital, or the improvement in operating margins. You simply would let the economics of the business dictate whether you were increasing or decreasing the value of your investment. In Buffett's mind, the litmus test for measuring the performance of a publicly traded company is no different. Charlie and I let our marketable equities tell us by their operating results, not by their daily, or evenly yearly, price quotations whether our investments are successful, he explains. The market may ignore a business success for a while, but it eventually will confirm it. But can we count on the market to reward us for picking the right companies? Can we draw a significantly strong correlation between the operating earnings of a company and its share price? The answer appears to be yes, if we are given the appropriate time horizon. When we set out to determine how closely price and earnings are connected, using our laboratory group of 12,000 companies, we learned that the longer the time period, the stronger the correlation. With stocks held 3 years, the degree of correlation between stock price and operating earnings ranged from 0.131 to 0.360. A correlation of 0.360 means that 36% of the variance in the price was explained by the variance in earnings. With stocks held for 5 years, the correlation ranged from 0.374 to 0.599. In the 10-year holding period, the correlation between earnings and stock price increased to a range of 0.593 to 0.695. This bears out Buffett's thesis that, given enough time, the price of a business will align with the company's economics. He cautions, though, that translation of earnings into share price is both uneven and unpredictable. Although the relationship between earnings and price strengthens over time, it is not always present. While market values track business values quite well over long periods, Buffett notes, in any given year the relationship can gyrate capriciously. 50 Ben Graham gave us the same lesson. In the short run the market is a voting machine, but in the long run it is a weighing machine. A variety of measuring sticks. It is clear that Buffett is in no hurry to have the market affirm what he already believes is true. The speed at which a business's success is recognized, furthermore, is not that important as long as the company's intrinsic value is increasing at a satisfactory rate, he says. In fact, delayed recognition can be an advantage. It may give you a chance to buy more of a good thing at a bargain price. To help shareholders appreciate the value of Berkshire Hathaway's large common stock investments, Buffett coined the term look-through earnings. Berkshire's look-through earnings are made up of the operating earnings of its consolidated businesses, its subsidiaries, the retained earnings of its large common stock investments, an allowance for the tax that Berkshire would have to pay if the retained earnings were actually paid out. The notion of look-through earnings was originally devised for Berkshire's shareholders, but it also represents an important lesson for focus investors who seek a way to understand the value of their portfolio when, as will happen from time to time, share prices disengage from underlying economics. The goal of each investor, says Buffett, should be to create a portfolio, in effect, a company, that will deliver him or her the highest possible look-through earnings a decade or so from now. According to Buffett, since 1965, the year Buffett took control of Berkshire Hathaway, The company's look-through earnings have grown at almost the identical rate of the market value of its securities. However, the two have not always moved in lockstep. On many occasions, earnings moved ahead of prices; at other times, prices moved far ahead of earnings. What is important to remember is that the relationship works over time. An approach of this kind, counsels Buffett, will force the investor to think about long-term business prospects rather than short-term market prospects, a perspective that will likely improve results. When Buffett considers adding an investment, he first looks at what he already owns to see whether the new purchase is any better. What Berkshire owns today is an economic measuring stick used to compare possible acquisitions. What Buffett is saying is something very useful to practically any investor, Charlie Munger stresses. For an ordinary individual, the best thing you already have should be your measuring stick. What happens next is one of the most critical but widely overlooked secrets to increasing the value of a portfolio. If the new thing you are considering purchasing is not better than what you already know is available, says Charlie, then it hasn't met your threshold. This screens out 99% of what you see. You already have at your disposal, with what you now own, an economic benchmark, a measuring stick. You can define your own personal economic benchmark in several different ways: look through earnings, return on equity, or margin of safety, for example. When you buy or sell stock of a company in your portfolio, you have either raised or lowered your economic benchmark. The job of a portfolio manager who is a long-term owner of securities, and who believes future stock prices eventually will match with underlying economics, is to find ways to raise your benchmark. If you step back and think for a moment, the Standard & Poor's 500 index is a measuring stick. It is made up of 500 companies and each has its own economic return. To outperform the S&P 500 index over time, to raise that benchmark, we have to assemble and manage a portfolio of companies with economics that are superior to the average weighted economics of the index. If my universe of business possibilities was limited, say, to private companies in Omaha, I would, first, try to assess the long-term economic characteristics of each business, says Buffett. Second, assess the quality of the people in charge of running it. And third, try to buy into a few of the best operations at a sensible price. I certainly would not wish to own an equal Oh.